Hello, this is Domenico with Easynomics, and we're going to do a paper 3 practice question in the macro unit looking at expansionary fiscal policy. We're specifically going to look at the Keynesian multiplier. There'll be a link below in the video notes to this video that explains the Keynesian multiplier and the concept behind it. In that video, we go over how any change in income can lead to a change in consumption or spending. And we're assuming in this case that households will spend 60% of any additional income. So if the household receives an additional $10 and 60% is spent, $6 will be spent of the 10, and that will lead to a second household receiving those $6 because if you spend $10, that'll be revenue to some entrepreneur, and that entrepreneur will pay out wages or they'll keep profit, so there'll be additional income to that household. And then we'll take 60% of that $6, which will lead to household 2 spending $3.6, which will eventually end up in household 3, and so on. So you can watch that video that explains step by step the conceptual idea behind the Keynesian multiplier. Assuming that you have some background knowledge on the Keynesian multiplier, you can go ahead and practice this question, which is going to be the focus of this video. So here we have a paper 3 type of question. Here, again, it's a Keynesian multiplier practice question. It says the US government's economists have estimated that citizens and residents spend 20% of any additional income. So in a Keynesian multiplier question, they're going to give you one or three of the following. So in order to calculate the Keynesian multiplier, you will need the marginal propensity to consume, and that will be enough because with that information, you can use the formula, and the Keynesian formula is, or the Keynesian multiplier is equal to 1 over 1 minus the marginal propensity to consume, which is also equal to 1 over the marginal propensity to save plus the marginal propensity to tax plus the marginal propensity to import. So you either will get the marginal propensity to consume, or you will get the marginal propensity to save, the marginal propensity to tax, and the marginal propensity to import. So in this question, they're giving us these three values, and that can also be considered the withdrawals, the marginal propensity to withdraw, the marginal propensity to withdraw, or marginal propensity to withdraw, MPW, which is the sum of marginal propensity to save, tax, and import. So in this question, again, they're giving us these three variables. So we're going to be using this formula right here. So let's highlight the data that they're giving us. So residents spend 20% of any additional income on imported goods, 20%. So with that being said, the marginal propensity to import is 20% of any additional income, or the decimal value of 0.2. Then we have the marginal propensity to save, which is 10%. So the marginal propensity to save is 10%, which is the decimal value of 0.1. And then they have here the tax rate on every extra dollar of income. The tax rate on any additional income is 10%. So the marginal propensity to tax is 10%, the decimal value being 0.1. So go ahead and pause the the video, and go and try question A. Using this information, calculate the value of the Keynesian multiplier. Pause the video and tell me what the Keynesian multiplier value will be. Go ahead, pause the video now. Okay, so what answer did you get for question A? Question A, we're just going to use that formula, 1 over the marginal propensity to save plus the marginal propensity to tax plus the marginal propensity to import, which is highlighting the leakages. If any additional income, if you save it, it's been leaked out of the financial system. It's not being spent within the circular flow of income. If you're being taxed, then the household has been prevented from spending that money. It's been withdrawn from the household. And if you're importing, you're sending your money abroad to another country, so that it becomes revenue to a firm in another nation. So we just plug in these values. The marginal propensity to save is 0.1, 0.1 plus the marginal propensity to tax is 0.1, 0.1 plus the marginal propensity to import is 0.2, 0.2. That gives us 1 over 0.4, which is equal to 2.5. So the Keynesian multiplier is 2.5. So any additional income that's injected in, for every $1 that's injected into the system, into the American or US economy, it will multiply out 2.5 times. And that is what this video is going over. So for any additional $1, you get $2.5 of additional spending in this case, or $10 or $25 of additional spending. All right, so that's, again, covered in that previous video. They'll be linked below. So you've answered that question. Part A, the Keynesian multiplier value is 2.5. Any additional dollar that's injected into the US economy will multiply out 2.5 times. Let's move on to question B. Using your answer in part A, calculate the increase in government spending necessary to increase nominal GDP by 2.15 trillion. So what level of government spending is needed to achieve $2.15 trillion of spending when the Keynesian multiplier is 2.5? Go ahead and pause the video and calculate what your answer would be on a paper 3 type of exam. Pause the video now. Okay, so let's look at part B. So the idea here is we have a change in government spending. We don't know what that value is going to be. And it's going to multiply out according to the Keynesian multiplier by 2.5 times. So some level of government spending multiplied by 2.5 will give us a total level of nominal GDP spending of 2.15 trillion. Okay, so we're trying to solve for this. So the change in government spending is going to be equal to 2.15 trillion, 2.15 trillion divided by 2.5. And that's going to tell us what that level of government spending is going to be. And that is going to be 0.86, 0.86 trillion, or we can say 860 billion. Okay, so that's what your answer would be. The government spending needed is 860 billion, and it will be multiplied by 2.5 to achieve $2.15 trillion of total increase in nominal GDP. So what's the idea there? Let's assume that we're in a recessionary gap. Let's assume that we're at where 81 intersects the Keynesian aggregate supply curve at point A, providing a price level at PL1, and we're in a recessionary gap with real GDP at Y recession. Or since we're using nominal GDP, let's assume that this is measuring nominal GDP. Fine. So we're at point A, and the government believes that the recessionary gap is $2.15 trillion. So the distance, let's see if I can use another color here. The distance between here and here is 2.15 trillion. That is the size of the recessionary gap. So the government wants to boost aggregate demand outward by changing or increasing government spending. And then by injecting money into the US economy, households will receive that injection and that will multiply outward. And that will achieve an additional level of change in aggregate demand. So we've calculated the government spending needed is 860 billion. So that means that the aggregate demand curve would shift out from 81 to 82. And that increase from 81 to 82 is a result of $860 billion of government spending being injected into the US economy. So that is 860 billion right here, or 0.86 trillion. So here we have that autonomous spending. We would call that autonomous spending, and that would lead to induced spending. And so 2.15 minus 0.86, the induced spending would be 1.29 trillion. So the government only needs to expand fiscal policy, expansionary fiscal policy of 860 billion. It will multiply up 2.5 times to close a gap of $2.15 trillion. Here we have the autonomous spending and the induced spending, which again is covered in this video here using the real world example of the COVID pandemic and the expansionary fiscal policy utilized by the federal government by providing cash payments to households to achieve greater spending in the economy and so on. Okay, so that's it. If you have any questions, feel free to comment those questions below. And don't forget to subscribe and to like. Thank you so much.